I think we've been in a debt crisis since the great financial crisis of 2008, 2009. And you see that from debt to GDP levels that continue to rise. The question really, and I think it's not just unique to the United States, this is a global fiat debt crisis that we have, that there's this, I call it a drug cycle, that the Fed printing money to buy debt basically obviously causes markets to go up, but we're funding an unsustainable amount of spending at the federal level.
How will a looming debt crisis impact markets? And are the markets pricing in a Trump or Harris victory by November? We'll find out with our next guest, Matt Cole, CEO of Strive. Welcome to the show, Matt. Good to see you.
Yeah, thanks for having me, David. Happy to be here.
Tell us a little bit about your investment strategy right now, your main thesis for the markets, and how that's driving your investment decisions.
Yeah, so first off, we have 13 different funds. 11 of them are passive equity index funds. I'm happy to talk about our outlook for equities into the new year and post-election, but they're passive funds. And Strive's differentiator is not in the return, the risk, the fee, but in our approach to corporate governance and pushing corporations to remove the constraints. All in on capitalism, all in on meritocracy, all in on innovation, and driving better returns through better governance. And that's our differentiator in our equity ETFs. Getting a little bit into our outlook on equities, though, you're obviously seeing record highs in the S&P 500 week after week after week. I think there's a lot of different underlying factors in that. Fed easing. I don't think that the underlying economic data is as bad as it looks. And I think the election is looking more likely like a Trump victory. And I think a Trump victory is bullish for markets. I think the backdrop for equities over the course of the next, call it 12 to 18 months, and just risk assets in general is extremely positive. But I think the backdrop from a longer perspective, though, I still think we have some tailwinds towards higher inflation. I think that's going to be a theme that can get under control, and it is under control right now. You've seen inflation moderate pretty drastically, but I think that that's true in periods. So when we say periods, call it decades, 1 decade, 2 decade period, that will have higher inflation. You can have periods of lower inflation. You can have periods where inflation goes negative within a period where the average inflation is higher. I think that's going to be something that we continue. And so when that filters into rates, and just to focus on the 10-year, I think right now we're in a range. I think we're in a range of around 3 to 6%. So currently, right around 4%. I think that's a place where, in my view, you don't really want to take a lot of duration positioning. So in our bond funds, we're pretty flat duration. We're taking our risks by going into structured products as a sector overweight relative to some other overweights. But as far as duration, pretty flat, but overall positive on risk assets out the risk spectrum, including into like cryptocurrencies as an example.
Well, let's just back up a minute. Did you say that the markets are currently pricing in a Trump victory? Is that what you said?
I do believe the markets are pricing in a Trump victory. I think you're seeing
what are the signs? Yeah, what are the signs you're seeing?
Mm-hmm. First and foremost, I think you can look at the crypto markets. I think when you start to see strength in the crypto markets, you see the strength fairly correlated to the odds in poly markets of a Trump victory. I think Trump will lead to less regulation to risky assets like crypto, and taking off some of the restrictive policies with regards to innovation in the tech sector. And I think that ultimately filters into a more bullish outlook for the markets. And I think the further out the risk spectrum you go, the easier that is to see.
You're right on poly market. Odds jumped in favor of Trump just in the last couple of days. What changed, do you think?
Yeah, it's interesting because to start this election cycle, I think you saw Kamala Harris being very hesitant to go out and do interviews. And I think that was an intentional strategy. I think you saw a similar strategy from Trump in the Republican primary, where when you feel like you're in a position of strength, you kind of take a position of, I don't really need to engage because I'm in the leadership position. And I think she started to see that falter, and that led her team to have her go out there more. And I think as she's gone out there more, you've seen interviews that have not gone well. I think the Fox interview did not go well yesterday. I think that led to a further repricing of Trump's odds moving higher. And I think now you see Trump really being the person that says, I don't want to debate, I don't need to debate. But obviously both now still doing the podcast cycles. And I think the more that both of them are out there talking to media, going to places where maybe it's not the most friendly outlet, I think that only plays to Trump's favor. And I think that you're ultimately seeing that being priced in the markets.
Before we continue with the video, I want to tell you about our sponsor today, Caleb & Brown. Bitcoin has reached new all-time highs this year, and many pundits and experts predict the price may go even higher in 2025, which is why it's so important to find a reliable on and off-ramp platform to sell and buy your cryptos with fiat currencies. Many investors have struggled with this year, and this is where Caleb & Brown comes in. Caleb & Brown offers over 300 assets to buy and sell directly with all major fiat currencies, and you don't have to experience limits or fees. This, in the fact that there are no trade maximums or withdrawal limits, means that clients can seamlessly place limit orders and stop limit trades. Caleb & Brown has been operating since 2016 and has gone through numerous bull and bear markets. They have a history of consistent uptime, even in the most volatile periods. Sign up now using my link in the description below or scan the QR code here. And you said that a Trump victory would be bullish for stock markets in particular. Can you explain why?
Yeah, absolutely. It's about regulation, and less regulation, more innovation in this country, I think will be a tailwind for U.S. equities particularly. And you could go a bunch of different directions with this. You could go energy policy, you could go AI policy. It's really, what are we unleashing in this country? Are we unleashing the spirits of American exceptionalism, or are we actually trying to constrain this country? And I think it's really two different philosophies for the world. One is more about constraints and equity as a concept, equity not obviously being equity in public equities, but making everyone more equal with regards to the wealth that they have. That is a constraint on innovation. And I think it's pretty clear that Trump represents, as a concept, more innovation, a more friendly cycle to cryptocurrencies in general. I mean, I think their stance to crypto is very interesting, because you have, I'd say, Trump going all the way into a crypto degen, right, where he has his own coin that he's released, which is interesting. And then you have Kamala make statements about, crypto for men based on the color of their skin. I think that's, but as a policy, the Democratic agenda would be much more towards a CBDC, and the Republican agenda would be much more towards decentralized cryptocurrencies and leaning into that as a concept. And I think that filters through into every layer of regulation of the American economy.
Let's talk about that. So suppose we do get a CBDC at some point. What would that do, if anything, to the rest of the crypto market, in particular Bitcoin prices?
I think a CBDC is negative for decentralized cryptocurrencies. And it's negative in a big way, because decentralized cryptocurrency is about freedom, the ability to buy an asset and have an opt-out from the system. A CBDC is about a forced opt-in into a system. So while the underlying technology might be very similar, the actual outcome is extremely different. And so my belief is that for America to be competitive, we need to lean into the opt-out of the system. That's the founding belief of American ideals. People came to this country several centuries ago to have an opt-out from Europe. America forcing people to opt in to a cryptocurrency, a CBDC, where the Fed could effectively act as the regulator, shutting off access to banks, is moving away from American ideals. I think it's ultimately extremely negative. I mean, it's basically very binary. You cannot have, in my view, a CBDC and also have policies that are allowing people to own true Bitcoin. Could you have Bitcoin, quote unquote, trademarks like a Bitcoin ETF? Yes, but it's important to recognize that a Bitcoin ETF in many ways actually runs contrary to the ideals of Bitcoin itself, because you can't actually take the Bitcoin out of an ETF and do what you want to it, send what you're held captive within the financial structure. And I think ultimately that's what was the motive behind cryptocurrencies in the first place. It's not just a finite supply of a single asset. It's actually the ability to opt out from a system. And when you do have an opt out from a system, it forces competition. I think Bitcoin in and of itself is extremely bullish to make America act well with regards to fiscal policy. And then lastly, this is a little bit of a tangent with regards to Bitcoin versus CBDC, but I think it's also important, is stablecoins. You've seen a massive rise in stablecoins over the last couple of years. I think that under a Republican administration, that trend continues, and under a Democratic one, it doesn't. Why? Because who are the buyers of stablecoins? It's people overseas that really want to access US dollars. And it solves a very unique problem that our country has, right? We have a debt crisis in this country. I don't think anyone would debate that the US has a debt crisis. What do you need when you have a debt crisis? You need a buyer of US treasuries. Stablecoins, and specifically Tether, but stablecoins are one of the largest buyers already today of US treasuries. And when you think about how does the US fund its deficit outside of monetary easing and the Fed buying treasuries, stablecoins represent a pretty unique solution to at least part of the problem.
Okay, you said we're in a debt crisis. I know the deficit and debt levels are projected by many organizations, including the CBO, to widen, but why are we in a debt crisis right now?
I think we've been in a debt crisis since the great financial crisis of 2008, 2009. And you see that from debt to GDP levels that continue to rise. The question really, and I think it's not just unique to the United States, this is a global fiat debt crisis that we have, that there's this, I call it a drug cycle, that the Fed printing money to buy debt basically obviously causes markets to go up, but we're funding an unsustainable amount of spending at the federal level. And as you see the amount of the actual tax payments that go to pay for just interest as interest payments has rise, it creates a cycle that's very difficult to get out of. And so you clearly see debt levels rising. The question is, how does it stop? And I haven't seen any projection. Obviously, you mentioned the official government projections, but I do not see either the Republican agenda or the Democratic agenda as being one that shows any level of austerity at the government level. And I just don't think that's a winning policy. And I say this, it's something that's painful for myself because I grew up as a pretty classical libertarian, small market government, very fiscally conservative. I don't see how that wins in this country. I don't see how fiscal austerity wins. And if it doesn't win, then debt to GDP just continues to rise as we can't get away from entitlement spending. Defense spending, I think, something that's not likely to go down when you look at the geopolitical tensions in this country. I think the ultimate result is a continual rising of debt to GDP levels. I don't have I'm guessing, I don't have a prediction of when it breaks. I don't really see this as a tradable strategy where you short US Treasuries as an example. That's not the point. I think the point is that debt levels in US and debt levels globally are going to continue to rise. And so that, I think, leaves a lot of room for places like Bitcoin to provide a diversifier, obviously a risky diversifier, to try to get outside that spiral.
Actually, according to a CBO projections, the Congressional Budget Office is projecting that by 2034, net interest payments will equal almost 40% of revenue from income taxes. How does that translate to shifts in government priorities and outlays, you think?
Well, it should translate into a need for austerity measures. I think the reality, the way our government works and the gridlock that you see in DC is really this continual kick the can down the road until something breaks. And I think that's what we're going to see in actuality. I think we'll continue to see more and more treasuries issued and potentially putting some pressures on rising interest rates. It's why I think even though inflation today is under control, I think that's a today phenomenon, maybe a next few years phenomenon. I think with the need to continue to issue more treasuries, you're going to have some very tough decisions. Does the Fed step in and buy more treasuries? What do we do? How do we handle this crisis? I have not seen anyone from the Fed to the federal government take a proactive measure here. And so my prediction is that there will be no proactive measure. There will be a reactive measure to something breaking. And when that something breaks, it doesn't seem like it's something that's in the near term. My best guess would be, if you had to ask me to put a date on it, somewhere between 2030 to 2035. But I think it's something that we all see, and very few people, probably including myself, will actually trade it in a way that produces a lot of alpha. But I think it's something we need to be cognizant of.
Okay, going back to your fund now, I see that for Strive 500, which is one of your flagship funds, a lot of your top holdings are in the financial and or technology sector. And in fact, the sector breakdown is as follows: technology 31.5%, financials 13%. Why the overweight in these particular sectors?
Simply because it's an index fund that is a market cap fund of the 500 largest companies in the US, and those happen to be the largest companies. So it's really it's similar to every other 500 fund, with one caveat. Our index is a Bloomberg index, and other large providers, our competitors, use S&P. And just an interesting note on one of the differences there. S&P's index, they have a committee. So if a stock becomes eligible for the index, like as an example, several years ago when Tesla became eligible, the committee has to approve it. And in that instance, the committee actually held their feet until Tesla was one of the 100 largest companies in the United States, actually cost the S&P 500 holders a couple hundred basis points of return. The Bloomberg index is purely quantitative. If it meets the criteria, it gets added, no committee. But the rise of the FANG stocks has done a lot to increase exposure to tech in broad-based indexes.
Are you bullish on tech overall, notwithstanding the sector weighting?
Mm-hmm. Yeah, I am, with some caveats, and some of those caveats is, I think some of the, as an example, regulation from the government with regards to Google. Are they going to have to break up? Are they not going to have to break up? I think there's a limit to how big some of these companies can get before they become enemies, probably of both the left and the right. And I think that ultimately will act as a constraint on them. But I think without that constraint, if you just talk about pure play, capitalism, I think it would be just all hands on deck, bullish. They're going to be the companies that are going to be able to take most advantage of AI, which I think will be a big driver of returns, but also something that I think could be difficult to predict the true winners of the AI boom. I don't think it'll be as simple as pick Google and that's going to be the winner. I think it could be outside the technology sector, depending on what regulation does.
What does America need to do to maintain an edge or lead in the tech field, especially in the development of AI, against, let's say, China, that is rapidly catching up and, according to some analysts, have already surpassed the U.S. in technological innovation in this area?
Yeah. My number one thing of importance there is actually to unleash U.S. energy, unleash nuclear energy, unleash fossil fuels, and unleash clean energy, because there's going to be a direct correlation to how much computing power you can have in a nation and how much energy you have. And I see us having not nearly enough. And you saw this, and this was from the early days of Strive, where our first ETF was a U.S. energy ETF. We were fighting back against the restrictions imposed by the ESG movement in this country, and there was no sector that had been constrained more than U.S. energy. And it was, it was a longer story, but basically you had the shale boom and you had overinvestment that related into, a weak energy sector. And then you had the ESG movement put its boot on the neck of a sector when it was really weak. And, you heard from all these executives in the energy sector about how much they were being constrained versus what they thought was optimal for their sector. We launched our ETF. We fought back against that in a major way. We still fight back against that in a major way today. But even then, when we saw that, we weren't forecasting the dramatic likely rise of demand for energy that the AI boom would cause. And so now I think that is on steroids. And I think it's really going to play out in the next 4 years. And to your point, I think China is a legitimate competitor here. And on energy, China has been way more friendly with regards to nuclear energy than the United States has been. And I think we're at a place where it's very, very critical for us to start rolling back nuclear regulations and really leaning into investing in energy infrastructure, which I think will ultimately fuel the ability for better AI across our country.
And I want to finish on this note because I know DEI and ESG are important themes for your funds. It appears that a lot of larger companies are rolling back on previous DEI policies. Microsoft recently, as you know, laid off an entire DEI team. I'm not entirely sure what that team has done to warrant that layoff, but basically its lead wrote an internal email blasting how DEI is no longer business critical. What's your response to this counter trend, if you will?
So this is something we've been asking of companies since our founding in 2022, and I'm really happy to see it. Why am I happy to see it? Because the trend of DEI in corporate America was based on a set of studies by the McKinsey Group that had zero accuracy with regards to the statistical significance with regards to anything in their data. So let me give you a couple examples. They had 3 different studies. They had overlapping timeframes. They were looking at different periods with different countries. They would randomly put countries in, like Canada, where you're from, and then they would remove them out. And then their studies also didn't even have a p-value of less than 0.05. And so what does data actually show with regards to diversity performance? The data actually shows there's no correlation. And I think that's good news, and I think that's also pretty intuitive, that if you hire the best people, you're going to have the best results, regardless of the color of their skin, regardless of their gender. And I think that for any company to lean into meritocracy is going to be critical as we move into the future. So applaud Microsoft for making that move, and hope several other companies do the same.
All right. Well, thank you very much. We'll put the links down below, so make sure to follow Matt Cole and his company there. We'll speak again soon. Welcome to the show.
All right. Thanks, David.
And thank you for watching. Don't forget to like and subscribe.